2023 has been one heck of a year in the stock market after the beatdown we all got in 2022. Now that 2023 is coming to an end, inflation isn't quite as high as it was in 2022, but I still think there are certain sectors where the prices are still way too high. With the Fed funds rate remaining at 5.25 to 5.5% going into 2024, a lot of investors are betting on the Fed to cut interest rates in 2024 as core inflation continues to trend in the right direction. And I'm going to talk about some of the stock market headwinds we might be facing later on in this video. But let me first reveal how my retirement accounts performed in 2023.
It's time to retire.
And as always, I'm super fired up to talk about this. And I'm not by any means trying to show off or brag about my progress, but to encourage you to stop focusing so much on what stocks to pick and start looking at the savings rate or the percentages of how much you're investing into your portfolio every month. Making 20% or 25% in investment return is rare. So I treat it like a bonus. And think of it this way. Investing $1,000 every year with a 20% return is $200. But investing $10,000 every year with a 10% return is $1,000, right? And I'm just giving you a different perspective here. And at the top here is where I'm going to show you the timeline of my investing journey and when I plan to withdraw from my retirement accounts. The first category I want to go over is my retirement accounts. And these retirement accounts are the money I'm not looking to touch until at least I'm 55 years old. My wife has a state pension fund, which has an incredible dollar for dollar 100% match, a 457B plan, and I have a TSP and solo 401k. I'm going to talk about how I diversified my 401k in about a week, so be sure to subscribe if you haven't done that already. If you've been following my channel for a while, I am a big fan of Thrift Savings Plan, or TSP, which is the federal government version of the 401k. I used to serve on active duty in the military, so I decided to keep my pre-tax retirement dollars with TSP after I left active duty. And as you can see here, my current TSP allocation is 50% C fund and 50% S fund. And I'm actually ending the year with the same allocation at 50% C fund and 50% S fund because both C and S funds performed a 25% returns. This is something I didn't expect to happen because the C fund outperformed the S fund until about November when the early Santa Claus rally came, when investors started pouring their money into the small cap stocks. And I'm starting to see a little bit of rotation out of large cap stocks to mid and small cap towards the end of 2023. And as you can see here in this chart that shows both C and S fund share prices, the C fund has been growing much more consistently throughout 2023. And the S fund really started to catch up here in late November and early December. And could I see this trend to continue going into 2024? Sure. Could I also be wrong? Absolutely. But my strategy for TSP will remain the same at 50% C fund or the S&P 500 and 50% S fund or the small cap index fund. I am much more bullish on the S fund because it's underperformed the market for the past 3 years now. And please keep in mind that this is my financial strategy, so it may not necessarily work in your financial situation. And if you want to discuss more about your TSP strategy, you can schedule your first free 20-minute session with me by visiting firesightchat.com/coaching. The next accounts I'm going to go over are my IRAs. And I'm not looking to touch my Roth IRAs until I'm at least 60 years old. My wife has her Roth IRA and I have my own Roth IRA. And I didn't start maxing out my Roth IRA until 2016 when I was 30 years old. Because of our income limits, we have to do what's called a backdoor Roth IRA conversion every single year. And because of the pro rata rules, I keep my traditional IRA at $0 or near $0 in balance. The only mutual fund I own in my traditional IRA is what's called the FDRXX, which is the Fidelity Government Cash Reserves that pays about 5% in APY after the management expenses. In 2024, I'm going to transfer $7,000 from my traditional IRA to my Roth IRA, and I'm still going to contribute up to the maximum every year before the conversion happens. That 5% APY could also help me increase my contribution if the IRS does increase it for the year 2025. And inside my Roth IRA is where I invest all of my tax-free dollars. And I have about 32% in the S&P 500 index fund, which is the VFIAX, 32% in the US Total Stock Market Index Fund, or VTSAX, 25% in Google, and 10% in PayPal. To be completely honest with you, if I could redo my Roth IRA all over again, I would probably just do the S&P 500 index fund, but I'm not going to change anything now because they both have very similar returns every year with a difference of 0.1%, and they each performed a 24% return in 2023. And Google was a stock I was extremely bullish on in 2022 when they went through a 20-to-1 stock split and when we went through a bear market. And man, did it pay off, because it's performed about a 59% return just in 2023. But just because the market is green, it doesn't mean that every stock is green. PayPal, for example, it's performed a negative 17% year-to-date return. And I looked at PayPal's income statements, and they're actually looking very promising going into 2024. Again, this is not in any form of financial advice. I just think PayPal is very undervalued going into 2024. Now, am I going to sell the stock? It will depend on the next quarterly statement from PayPal, but I highly doubt that I'll sell any of it. And I might even buy more when the share price is still at around $50 or $60, and we'll see about that one. But anyway, my Roth IRA made a total of 22% return just in 2023, which is cool. My wife actually made more in her Roth IRA with just one index fund, which is FZROX, or the Fidelity Total Stock Market Index Fund. I'm not mad that she made more in her Roth IRA, but I'm just a little bit salty. Just a little bit, whatever.
A little touch of salt.
The next one is our HSA, Health Savings Account. HSA is a huge part of our retirement planning because not only does it grow tax-free, but it can pay for our Medicare premium when we turn 65 years old. And we all know how expensive medical expenses can be, and we can't predict our health conditions like we can with everything else, right? So in 2023, we contributed a total of $7,750 in 2024. The contribution limit is being increased to $8,300, and we plan to maximize the contribution again. And our HSA is very simple. Most of the money is in the S&P 500 index fund with an 80% allocation, and 10% of it is in QQQ, and the remaining 10% is with SCHD, or the Schwab High Dividend Yield ETF. The S&P 500 index fund made a 24% return, just like my Roth IRA, because the contribution schedule is exactly the same. QQQ, on the other hand, made a 36% return this year in this portfolio. And if we invested that back in January, then we probably could have made a 50% return. But hey, 36% is pretty damn good too. But we didn't add SCHD to our portfolio until about June or July this year, but it's made a decent return with a 5.39% return. The overall HSA portfolio made about a 22.2% return. And keep in mind that our HSA requires us to keep $2,000 in cash before moving money into our investments. And just 2 years after opening our HSA, we already have almost $20,000. So we feel pretty good about it. And going into 2024, we're looking to increase our investment into QQQ from 10% to 20% allocation. We're not going to sell any investments from the S&P 500 index fund because the allocation will just change if we focus on the QQQ next year. And there are some headwinds in the stock market in 2024 that I really want to pay attention to. The number one catalyst I want to pay attention to is inflation. The Fed is paying attention to this one too. If core inflation remains above 4%, then the Fed could keep the interest rates where they are for a little bit longer. That could potentially hurt the growth in the stock market. The other catalyst is the Federal Reserve itself. The CME Group is betting on the Federal Reserve to start cutting interest rates by 25 basis points in March 2024. And I'm not sure if that is actually happening until May or possibly June. This is why I have to pay attention to core inflation, wage growth, unemployment, and company earnings. And the other catalyst that many people forget about is the presidential election in November. And I think 2024 is going to be very messy with the election season coming up. And geopolitics are always unpredictable. We still have a conflict happening in Europe and the Middle East. China's ambition to invade Taiwan is still on the table. I know investing can be very stressful, so I encourage you to get your financial resources for absolutely free by visiting firesightshare.com/resources. Do not need a credit card to apply whatsoever. These financial resources are absolutely free for you to use. But how I invest will remain the same no matter what happens. What could be different is if we actually see a market downturn at the beginning of 2024. If we see a rotation, then we'll end up investing more. If I see the market drop 5%, 10%, 15% or more. And that's exactly how we invested in 2022 when we went through a bear market and the stocks were selling at a steep discount. We bought a lot of stocks, index funds, and ETFs at a discount when the US economy shut down in March 2020. We never fear the market because we're always in the market.